Hey, good morning, everyone. It's Coach Chris coming at you with a little different video this morning. I want to spend a little bit more time talking about a few concepts I've been working on and some things you may be working on. Before I get into it, I need to thank everybody who's purchased my systems. I'm really appreciative and all the new subscribers. I also need to tell you that this video is intended for educational purposes only. I'm not a financial advisor. I will never trade money for you or ask you to give me money to trade with. Futures trading is extremely risky. You can and probably will lose money. The complete government disclosures can be found via the link in the description below. So let's just get into this. Now, one of the things I've been thinking about is all of us are at different points in our trading journey, meaning that our experiences are different. Also, what we're looking to achieve out of our trading is probably different. Now, one of the common things that I think all of us are looking to do, obviously, we're here looking to make money. And so the problem is, and it's kind of a catch-22, is we're here looking for money, but if we focus too much on the money, it does something with our brain and gets in our way. And we're so affixed on the monetary, both making money and not losing money, that it causes us to act differently than what it probably should. And I like I said, I know it's very hard to explain, but hopefully it will make more sense. Now, I want to be careful because I've got a lot of things I want to talk about, but I also don't want to confuse you in this video. So I'm going to cover some things, but I want to make sure what I do cover is clear and not add some additional concepts and save those for future videos. So that I'm not bouncing all over, because I have a tendency to do that, I understand. So this morning, what I want to concentrate on is, instead of having an attitude of just coming into the market and grabbing, a few points here, I guess scalping is the best word, where you're just coming in and looking for 2 to 10, say 2-point to 10-point moves in a real short period of time and then getting out. Now, there's nothing wrong with that. But what I'm trying to get at is longer trades with more money captured, with a lot less mental energy having to be expelled. The problem is the market obviously doesn't always give us setups to achieve that. Obviously, the best time to achieve that is usually from a period of, say, 1 to 2 hours before the market opens till about, I would say, 11:30 in the morning. Now, that's not to say you won't find it at other times, but that's when we're seeing the most activity in the market and the most price movement. Now, one of the things that happens is that we get caught up, as I was saying earlier, in our own mental roadblocks. We have preconceived notions of what the market should be doing. We react very quickly to news items and different built-in biases that cause us to sometimes act in ways we shouldn't act in. And some of this may be clearer as I get into this. But this, I'm going to illustrate something here. This is yesterday morning. So I'm filming this Saturday, September 28th. And so this price action was price action that occurred on Friday, September 27th. And I'm looking, these charts are starting right here at 6 a.m. Central Daylight Time. So that's approximately 2.5 hours before the New York Open. Now, one of the things I do want to point out is we knew there was news that was coming out at 7:30. Excuse me, I got a little frog in my throat. There was some news that was going to be announced at 7:30 in the morning Central Daylight Time, and it was going to be high impact news, and it was a series of news. I can't remember if it was unemployment, PCE. Anyway, it was something that we knew was going to affect the market. And so we started to see early on, even before 6 a.m. my time, going back 3-4 hours, we were seeing quite a bit of movement in the market. Now, one of the things that I've been really spending a lot of time on is looking at different, what I'll call patterns or waves of how the market moves. And there are times when we're getting good market movement, like I just showed you, up and down. This is what we like. We like a big move up. Look at, we triggered into a long and it responded very quickly. This is a 2-minute chart, by the way. For what is this, 3 a.m., 3 in the morning, we're getting some nice movement up and down. Now, the key of what I was getting at is, yes, we do like movement, but we like it in more of a predictable nature, meaning we don't want to just see, huge upswings and then, downswings. We want it to be behave in a manner that's more predictable. And what I mean by that is we like these. Like take a look at this movement. It's nice and controlled and predictable. Market goes down. And then what does the market want to do? It wants to go up, which it does here, nice and easy. Then it wants to go down. So this is kind of nice price movement, up and down rather than rapid zig, all over the place. And like this price action in here, really erratic, where we don't, it doesn't have a rhyme or a reason. Here, this is very difficult to trade, up, consolidation, up. Yeah, I guess if you examined it closely, maybe it is predictable in some sense, but I hope you get what I'm meaning. And so with that in mind, let's just look at a couple of things here. This, as I said before, this is 6 a.m. Central Daylight Time. And what I've done is I've split the screen here to help identify what we may be doing wrong, what we may be doing right, and how in the heat of the moment, because when we've got money on the line, whether it's real money or prop firm money, because remember, either way, prop firm money is real money in the sense that we're paying for the evals, and once we pay and we're in the funded or the XFA or the PA, whatever you want to call it, that is real money. We've invested a lot of time into it, and it can be converted into cash. So in a sense, it's not always dollar for dollar real money, but ultimately it is real money. And that adds pressure on us, and it causes us to act differently. And so getting back to how we can extract money from the market, if you look on the left, these is a chart with regular candlesticks. And we know what happens is, if we look at a candlestick, it has an opening price, a closing price, which is the body, and then the wicks are where price moves. So for instance, on this candle, price actually moved way down to here at one point and way up to here at one point, but this is the open and close. Now, there's another way to visualize candles, and it's called the Heiken Ashi candle. And it's a Japanese way of looking at candles. And what it does is it smooths out some of these ups and downs so that when a trend is forming, it's much smoother. You can see over here. Now, what I've done here, I've also put on this chart these little white dots here. That is the actual price of the underlying, as opposed to the regular candle, a Heiken Ashi candle, the price isn't indicated by the body, okay? It's actually an average of the previous number of candles. And if I go here, there's a lot of information available for about this on the internet. And if you just search, you'll find it. And so what it is a way of smoothing out price action. And you'll notice when price is going up, the wicks on the candle are only at the top of the candle. There's no shadows below it. And then we get a pivot, and then the reverse is true when we're going down. There's little to no tops on the candles when price is going on. And the dojis become very important. A doji is a small candle, a small bodied candle with big wicks on either side. And that indicates, the same as with regular candles, is a change in direction. So that is the difference. So if you use a regular candle chart, you can see how chaotic this looks, as opposed to when you look at the Heiken Ashi candles over here. You notice how smoother it is, but as I said before, because it doesn't always indicate the price directly, it's sometimes hard to trade off of the Heiken Ashi chart. And so what I've been doing is taking the regular candle chart to trade off of and having the Heiken Ashi as a smaller representation of the same time frame, knowing that as long as this is smoothly going up, we can feel comfortable staying in the trade longer and getting that extra amount of points out of the trade that we otherwise may not have. Now, one of the other things you can use in addition to the Heiken Ashi candles are trend lines. And so you can see here, we're on a nice trend up. I drew this green line right here at the upper level of the candles. And you can see here how it's consistently going up. It will go up, pull back, touch the trend line, but it's always going up. The thing we want to watch for is any break of that trend to the down, since this is an up move, any break of that trend to the downside is an indication of warning. And so here, well, and this was news, remember, also, but you can see here that as long as it's just a wick that goes through the trend, it's not of grave concern, but it's a warning sign. And you can see here where this candle actually touched it at the bottom of this trend line, where it hadn't happened until, since when the trend began. And so that's a sign of warning that we may be coming to the end of that particular trend, which in this case would have been a really nice trade if you got in here. Almost 100-point trade, which is really nice. And then the indicator did a very good job overall. We did have some anomalies here of breaks. You can see how if you use the red basis line as a trend line, you can see here how once you start to deviate from that overall trend, that's a warning sign. You may want to get out. But look at this over here with the regular candles as opposed to the Heiken Ashi candles during that same time period. You see how smooth it is. But you can also see, look at where the price is. It's very deceiving. You get so used to assuming that price is right following these candles, which as long as it's continuous, it usually is a fairly close representation. But here again, once it deviates, you can see how far off the beaten path we get with it. So I hope this hasn't been too confusing, but what we want to do is use all of the tools at our disposal to help us keep us in trades that are profitable, and help us to warn us when conditions may be changing and that it may be time to get out and then wait for the next trade setup to appear. Because if you can eliminate like chunks like this, where there's no rhyme or reason, we can eliminate the losses and then the potential for revenge trading and other negative types of trading. And with just 1, 2, 3, or half dozen trades, make, enough points to help us achieve our monetary goals for the day. So I hope that's helpful. Go ahead and do some more research on the Heiken Ashi candles if you plan on using them, just so that you can become more familiar with them and possibly add them to your toolbox of tools to keep you on the right side of the market. So hope this helps. Coach Chris signing off.